The big question is, will the central bank stay its course, fight inflation, and let bond yields rise, force the government to change its fiscal policy culture towards more stability-oriented recognition of hard budget constraints, or will the government force the central bank to change course and monetize the debt? The politicians live in the old world, where basically issuing debt was for free. But the market is in the new world, where now debt has a price again. And these two worlds are clashing right now. And we will see who wins in this.
Global bond yields surged this week, causing volatility in the stock markets. The Dow fell more than 2% earlier this week. What's next for bonds, stocks, and economic growth globally in light of tariff uncertainty? We'll be discussing this with Thomas Mayer, founding director of Flossbach von Storch. He was previously chief economist at Deutsche Bank and also worked for the IMF, Goldman Sachs, Salomon Brothers, and other firms on Wall Street. Welcome to the show, Thomas. Good to see you.
Hi, David.
You have previously been a little bit more cautious on economic growth globally, given the tariff uncertainty. But now that we've had a 90-day pause signed between China and the U.S., are you starting to revise that outlook? Is this the beginning of renewed economic growth, do you think?
We were pretty cautious when the whole thing was beginning, not adjusting our outlook as things proceeded. We want to wait and see what eventually comes out. So far, first of all, Mr. Trump has shocked, of course, the markets when he did not do what they were expecting, i.e. start with the nice things, deregulation and tax cuts, but came with the tariffs. And especially with the reciprocal tariffs, the table shocked everyone, and everything went haywire when we saw this. Economically not well-founded, let me put it this way, tariff table. But then I think he showed that he would react to market feedback, and I think we saw this in reaction to his tariff actions, as well as later on when he attacked Jay Powell. He retreated on both counts. So in the event things settle down, and we are now sort of looking at a world which will have higher tariffs than before, but not as high as initially indicated. The Chinese special tariff, let me put it this way, I think is an effort to undo Chimerica. This was a phrase coined by Neil Ferguson a couple of years ago, quite a few years ago, which described the strong interlinkage between China and the US. In a sense, it all was almost like a symbiosis. China was industrializing, and the US was financializing in the process. So China ended up with a big industry that could export its surpluses to the US. The US had a big trade deficit and was importing capital from China, i.e. the Chinese were taking on the treasuries. This seemed for a while a viable symbiosis, but in this symbiosis, there were also losers, right? This were the blue-collar workers who lost their jobs when the US was deindustrializing and financializing, while China was industrializing. They got the jobs. So the blue-collar workers looked for a political lobby and found this political lobby in Donald Trump. And that has been sort of his theme quite along. And now he's trying to undo something I think was benefiting to the world, benefiting to China, benefiting to the US, but harmful to this particular group that was neglected by other politicians. He went out to undo now this symbiosis, and also in the process to lash out at other countries. So in a sense, he identified an important problem, but I think he's going about with the wrong solutions, and this will probably harm the US and the rest of the world, but to a lesser extent.
So then, do you think that this rally that we've seen since the beginning of May in the stock markets, is that going to sustain, keeping in mind what happened in the first Trump presidency when tariffs in 2019 knocked back the stock market by about 20%, but we've had a V-shaped recovery ever since?
I think the U.S. stock market was due for a correction anyway. I think if it would be looking at present levels and just abstract from Donald Trump, we would say, well, that was to be expected. In between, of course, we had a huge amount of volatility due to this tariff back and forth, but some readjustment of extremely high valuations, some flows out of the US stock market towards Europe, which has benefited basically from the development since the beginning of this year, was to be expected. So what Donald Trump did was introduce a lot of volatility. Eventually, I think we'll end up in a world where people will attach somewhat higher risk premium to US assets because of this volatility. The loser, in a sense, is the US dollar, as questions now have grown up whether the dollar is still a reliable international reserve currency. We can talk about this. I think there's still no alternative to the dollar, but obviously people are questioning it. And what we have seen in the bond market, I think, is part of a longer bear market in the bond market that we have entered basically at the end of 2021. We have benefited from a 40 years bull market from the early 80s to the early 20s. And we are now in a bear market, and this bear market doesn't go along in a very even way. It goes along with backs and forths, and now we have a phase where the bear market goes on a bit more as people have come back to realize that state debt, government debt matters. Long thought the bond vigilantes had gone away in hibernation, but they have come back. So government debt matters, and government debt is out of control in the US, but elsewhere as well. So we have seen sort of some changes in the bond bear market a bit stronger than before.
Before we continue with the video, I want to present to you some must-see data on gold. Now, this is the breakout moment for gold in charts. As this chart illustrates, the bull market in the 1970s had 200 all-time highs for gold. The 2000 bull market had just over 100 all-time highs, but this present bull market has only seen 74 new all-time highs so far. So gold spot price has seen a collective 180 new all-time highs in the past 25 years and has more than 10x'd for a century-to-date appreciation of more than 1,200%. Meanwhile, the gold mining industry has faced a number of unique challenges, including from 2010 to 2025, exploration budgets have stagnated or declined. Discoveries have plummeted between 1990 and 2023, and global gold production has stagnated with projections of a 17% supply drop by 2030. Existing mines are now depleting faster than new discoveries are being found. Several Wall Street firms are very bullish on gold. JP Morgan, for example, is calling for $4,000 by 2026. The last bull market for gold-related companies occurred more than 13 years ago. While gold has appreciated by 75% from 2011, the GXJ index has depreciated by 63%. Everything I just laid out brings me to today's sponsor, AxCap Ventures, ticker GARLF on the US exchange and AXCP on the CSE. AxCap Ventures was incorporated to make investments to rapidly capitalize on the distressed conditions of the gold industry. The management assumes that their assets, which are comprised of roughly 5.57 million ounces of gold equivalent resources in the measured and indicated category, and an additional 0.5 million ounces of inferred, are valued at around $5 an ounce, while peers are trading for more than 8 times as much, or 700% more. AxCap Ventures' flagship Converse project in Nevada's Battle Mountain Trend, a premier gold jurisdiction producing 75% of US's gold, is a standout. The project's October 2024 mineral resource estimate reports 5.57 million ounces of measured and indicated gold and 0.42 million ounces inferred, with a drill program launched in March 2025. Insider purchases totaling $1.2 million in Q1 2025 signal strong management confidence. The team assembled to run AxCap Ventures has been involved in the discovery of over 20 million ounces of gold with previous endeavors. So start researching AxCap Ventures today. Information and links down below. The long end of the curve, the 30-year rising above 5% now, does that signal to you higher inflation or higher economic growth or something else?
It signals to me a risk premium that people are attaching to US assets. We come from a world where politicians thought that basically every level of debt was financeable. If you have zero rates, and in Germany we even have had sometimes negative bond yields when you think about it. Basically, there is no constraint to government debt. And I think the political sector has adapted to a world where basically money seemed to be free. This was a world that was created, by the disinflationary impacts of globalization and technical progress. Inflation was very low. The central banks lowered rates. Bonds could rally. This world ended with the return of inflation in the wake of the pandemic. Now, as inflation is higher than before, even though it's down from the peak, but it's higher than before, there is no prospect for interest rates to go back down where they were. So now governments have to pay when they increase debt. The political sector, I think, hasn't adjusted to this new environment. They go on like before. They introduce tax cuts without funding. They want to have their cake and eat it too. We have in Germany a very big increase in the projected debt as the new government needs to increase investment, needs to increase defense spending, but doesn't want to cut back on the overblown welfare state. So they think they can all fund this through new debt issuance. Equally, in the US, we have tax cuts without funding. The politicians live in the old world, where basically issuing debt was for free. Yeah? But the market is in the new world, where now debt has a price again. And these two worlds are clashing right now. And we will see who wins in this.
Do you think that the bond market is signaling perhaps that the Federal Reserve in the U.S. will not cut rates anytime soon, or maybe not cut as much as anticipated, which is why yields are rising and not falling?
Well, yes, the Fed plays an important role. The central banks in general play an important role in this game. When the politicians think they can fund anything for free and the investor don't buy that, and they say we're living in a world where money has a price again, you would expect the investors to win. Because if they don't buy what the government offers, the seller has a problem, right? And then yields rise, the economy suffers, things get bad. Eventually, the government would adjust. They would change their culture towards a more conservative fiscal policy. But here comes in the central bank. Governments can fund themselves through bond issuance, or eventually also by forcing the central bank to issue more money. That's the fiscal theory of the price level. You can sort of translate this into actual market performance. The central bank buys government bonds, prices go up, yields go down, everything for the government is fine. But money supply increases and inflation potential is created. So the big question is, will the central bank stay its course, fight inflation, and let bond yields rise, force the government to change its fiscal policy culture towards more stability-oriented, a recognition of hard budget constraints, or will the government force the central bank to change course and monetize the debt? The Fed presently, I think, is trying to stop the government from continuing its policy of fiscal profligacy, but eventually the government is stronger than the central bank, because the central bank is a government agency and it can change it. So right now we shall see how this cultural battle of fiscal profligacy or monetary stability plays out. The Fed, I think, will resist. They will resist cutting rates. In the longer run, governments are stronger. That's at least what economic history tells us.
Do you think U.S. markets will continue to outperform relative to other global markets, emerging markets, and or other developed markets? Or do you think American exceptionalism is here to stay and will remain evident in stock markets?
I don't think that American exceptionalism is dead. But when I talk about American exceptionalism, I look at the economic drivers of it. And this is impressive productivity growth. You don't see this in the other industrialized countries. Productivity is falling in the UK, productivity is falling in Germany, it's not great in Japan either. So what I regard as the backbone of American exceptionalism is really the performance of the economy. The stock market, as we know, sometimes gets overexcited and then it falls back. So in that sense, what we have seen is basically an overexcited stock market about the American exceptionalism, which people sort of associated with the performance of the Magnificent Seven, of which a significant group had actually also very good profits. And now there was probably an exaggeration in the valuation of these companies that is correcting. Now, as the financial press was writing up American exceptionalism as the stock market was rising, they're now writing it down. But below that, ups and downs of the stock market, I think is a very strong productivity development, and also, of course, the entrepreneurial culture that you cannot find in the other markets.
I read something interesting on social media the other day, and I'd like you to just respond to this if you could, Thomas. The S&P 500 is composed of the 500 largest, arguably most profitable and most successful companies in their respective sectors in the U.S. markets. And so it's designed to only have winners. If the company starts to underperform and shrinks in size, it will by default fall out of the S&P. And so given that logic, it's pragmatic for an investor to just invest in the S&P 500 index, because by default you're investing in the winners of the American stock market and you just leave your money there. Does that make sense?
That makes sense in principle, but you have to qualify it a little. The S&P 500 index, like other indices, are managed, rebalanced, usually on a quarterly basis. And if companies decline in market valuation, they eventually drop out of the index, right? They go down, they drop out, the rates go down, and eventually they drop out of the index. So you do not buy a fixed portfolio. You would do this if you go to the equal weighted index. Then you have all the companies that are in the index equally weighted. In the capital weighted index, you have adjustments. The big question is, when you have significant changes coming fast, whether the rebalancing that you do on a regular basis reflects this on a timely basis. And here come the active managers, and tell customers, well, I'm ahead of the rebalancing of the index. The question is, do you trust that this manager is so skilled that he really has a better pick?
So Thomas, given our discussion so far, would you be allocating more towards stocks and bonds, or is there another asset class you prefer? And if so, which jurisdiction in the world?
Yeah, I continue to like stocks, because I think that the bond market is in a bear market. As I said before, I think we had the end of a 40-year bull market in bonds. Now we're in a long-run bear markets. Bond markets tend to move in very long cycles. This is not like the stock market. A couple of years, they can stretch over decades. So bonds is not something that I like. So I would, if I have to invest money in bonds, I would stay at a shorter duration end. Stocks, I think, will continue to perform, but not at the stellar rate that we have seen over the last few years. If you had asked someone in 22 if he would see a market like we saw actually in 23, 24, most people would have said impossible. So we have had a great run in the stock markets globally and in the US in particular. Going forward, I would hesitate to think that this would go on as it happened. We will see continued good performance, but high valuations that we had suggest that the future returns will be a bit lower. This is not bad. It's just a normalization. Other than that, we've talked about the government debt, and I think government debt is probably in many countries out of control. So this has an increased risk that inflation will make a comeback, and the central banks will be forced by governments to not to fight this, as the governments loathe higher interest rates. So therefore, you can you have a higher inflation risk. You also have geopolitical risks, war, trade war, hot war. So gold is an asset, which many people think it's a bit of an insurance against all these risks that are around. And by the same token, some people also think Bitcoin is an insurance against such risks. This is why we have seen a pretty good performance of Bitcoin as well. So I would have a portfolio in which I would have the core would be in stocks. I think to have a cash component that if I need current expenses, I would be in shorter duration bonds, and I would have gold and a little bit of Bitcoin to hedge for higher inflation and geopolitical risks.
All right, turning now to the European markets. This is from the ECB, an article from CNBC published this recently. In its financial stability review, the central bank discussed the recent spike in market volatility off the back of global trade tensions driven by U.S. tariff policy. The report said that a fundamental regime change could be underway in financial markets as investors appear to be reassessing how risky U.S. assets really are in the wake of U.S. tariff policy. These moves may have also reflected perceptions of a more fundamental regime change, with investors seeming to reassess the riskiness of U.S. assets and possibly leading to broader shifts in global capital flows. First of all, do you agree with this assessment? And if that is correct, where are these capital flows now being redirected?
There's always risk. And you can't say that there is zero risk of money flowing out of the US. But the question is, can there really be a run on US assets? And if so, where would they go? I think the biggest problem is that right now investors may have some stomach ache about US fiscal policy, about US tariff policy and all these things. But eventually, I don't see, and I don't know anyone who sees, a credible and ready alternative to the US dollar as the international reserve currency and to US treasuries and as international safe assets. The treasury market, look, is 11 times the German Bund market, and the Bunds are the safe asset in the Eurozone. So if you go from treasuries into the next safe asset, i.e. Bunds, it's just a little pond. Yeah, you go from a big lake to a little pond. It's not working. If you go out of the S&P 500, let's say go into a European index, let's say the DAX. The DAX is a small pond again, and you have this big lake. You can't get into it. If people make marginal reallocations, which I think they have done in the course of this year, it need only be marginal reallocation towards Europe, as companies in the DAX were relatively cheap. You see big effects, and you see the DAX run ahead. But there is no ability to get out of the US assets in large scale at this point in time. Would you want to go to China? I think most people wouldn't. Would you want to go to Japan? I think most people wouldn't, as Japan is kind of a quasi-stagnant economy with a very rapidly aging population. So for the time being, I think the US remains dominant. And I would also say that beyond the stock market, there is still a lot of dynamics going on in the US economy. Potential growth in the US is much bigger than in Europe and Japan.
Now, this is from the ECB report that I was just referencing. I'll share my screen one more time, Thomas. So rising trade frictions and related downside risks to economic growth are weighing on the outlook for financial stability, said the ECB vice president. The significant increase in trade policy uncertainty and trade frictions triggered large spikes in financial market volatility and raised the risk of an economic slowdown. How significant are these risks specifically to the financial sector of the ECB?
You have to keep in mind these risk assessments sort of always emphasize, what could go wrong. And there, of course, is always many things can go wrong. And I wouldn't say that what they say there is completely unbased. These risks are there. But I think that still the markets have remained, fairly resilient. I have heard so many talks when the central banks were in rate hike modes, that we will see, some skeletons falling out of the closet. There was talk about private equity or private credit, especially private credits, to get into problems. There was lots of talks about what could go wrong, and we have done relatively well. Now, these risks are there, but they haven't materialized because perhaps the system is more resilient than we thought. And of course, Mr. De Guindos is right to point to these risks, but I don't think that these risks are so severe that we have to really consider them as part of our baseline reference scenario. I think overall, the world economy is not at its best naturally, but it is okay. And financial markets are not at their best. We have seen the tremors, but I don't see a big crisis around the corner. Of course, crises come always unexpected. That is their nature. But I don't see that we are in a situation where we have to really get out of the market and go to some safe, so go into cash or something like that. That I don't see. I wouldn't want to be totally uninvested at this point.
Well, what about growth overall in the Eurozone relative to the U.S. that we were talking about? You mentioned that growth and productivity in the U.S. is impressive. How would you compare growth in these two regions from an investor standpoint, and which region would you prefer?
I mean, when you look at the underlying economic fundamentals, still everything speaks for the U.S. In the U.S., you have had impressive productivity growth, especially since the pandemic, as the US had more structural change than Europe. And in the US, people were laid off, they lost their jobs, they got their pandemic checks, and when they returned, they found other jobs. Some went into the same jobs, others went into other jobs. In Europe, the method was to keep people on the payroll and subsidize them while they were in lockdowns. When the lockdowns went over, they came back to the old jobs. But meanwhile, the structure had changed. So in the US, the pandemic was, in a sense, a catalyst for structural change. In Europe, the structures remained the same. But even before the pandemic, we had lots of structural rigidities in Europe that you didn't see in this extent in the US. So since in Germany, we have seen a reduction in productivity defined as real value added per employee since 2017. In the US, you have seen robust growth. In the European, in the euro area in total, we have seen stagnant productivity since 2017. This year, Germany will probably have its third year of stagnation, no growth. The Eurozone will have growth that is barely visible, 0 to 0.5%. About 0.5%, the consensus is the US will have probably 3 times or 4 times that. So from that point of view, economically, the US remains attractive. But as we discussed before, the Trump administration is bringing a lot of uncertainty.
Okay. People are concerned about the level of debt in the U.S., the rising debt, rising deficit levels. Now, Javier Milei, president of Argentina, recently instituted austerity in his country. He slashed public spending by up to 26.8, almost 27%, and privatized a lot of state assets. Could a similar method of austerity work for the U.S.? Certainly Germany has done something similar in the past. I wonder if it could work again.
You have to be ready for this. I mean, Javier Milei inherited an economy that was really down on its, well, not even down on its knees. It was flat on the ground, I mean, it is a miracle that Argentina is at all showing signs of recovery. And most people I myself had written off Argentina. It's a basket case. It was a formerly developed country. They were very, very strong in the 1930s, right? But that seemed to be gone. They seemed to be gone like old ancient Rome. But now the pain was probably for people so immense that they went for this experimental treatment. They probably considered it as experimental because Peronism was socialism, right? And here comes along a guy with very libertarian views, inspired by the Austrian school, which probably the average Argentinians had no clue what it is. Along comes Milei, an economics professor inspired by the Austrian school, and makes radical market-oriented reforms and has success. So I look to Argentina as a very interesting turnaround case. And I keep fingers crossed that he continues to have success. And one element that he did was he really cut back on government deficits, balanced the budget, therefore brought the money creation down by the central bank, which in the past just pushed printed money to fund government budgets. That was one element. And the other element was really comprehensive and fast deregulation. They have this Ministry of Deregulation, and they go through everything that they think hinders economic activity. So they really cut red tape and kept a bare minimum of regulations that they consider necessary to make the economy work. That is a great success story, but it also tells you one thing. To become such a radical reformer, you have to really, really have bad situations. And neither in the US nor in Europe, conditions are that bad that you can have a Milei policy. There is some hope, I would say, that in Germany, where we have now a new government, they will not go on as always and continue on the past course. But the new Chancellor Friedrich Merz will make some changes, not as radical as Milei. Soft changes, but at least some changes.
I understand. All right. Thank you very much, Thomas. Where can we follow you and learn more from your work?
You can see my work at the site of the Flossbach von Storch Research Institute. So if you just Google that, Flossbach von Storch Research Institute, you will see our stuff. And also if you Google my name, Thomas Mayer, you will find a lot of stuff on the web as well.
All right, we'll put the link down below, so make sure to follow Thomas there. I appreciate your time. It was good to meet you, Thomas. Welcome to the show. Look forward to speaking with you next time.
Okay, nice to see you, David.
Thank you, and thank you for watching. Don't forget to like and subscribe.